Hey everyone, and welcome to this Tuesday edition of FreightWaves Now. We got a big show today with Luke Falasca with a brokerage update. Then we got Mike Baudendistel with a Rail and Intermodal update. But up first, that carrier update presented by PowerFleet. Stay tuned. Everyone, and welcome to your carrier update presented by PowerFleet. I'm Strickland, and we are continuing to see tender rejection rates increase, but volumes flatten out here. So tender rejection rates up to 6.4%, taking a pretty decent jump the other day, about 11 basis points from 6.29 or 29% to 6.4%. We are expecting this number to continue to climb as we approach the July the 4th holiday. Capacity tends to come back offline around the holiday. Again, this year's not the normal year, so we're not really sure how much that's going to happen, but it does appear to be en route right now, especially as volumes, even though they're not increasing right now, they are at an elevated level. So still way up over 11,100, not making a big significant jump just yet, but you know, it's still early in the week so far. So traditionally, we see a peak of volume around the third week of June. So next week sometime, we should see this peak out if we follow traditional seasonal patterns. Third week of June is traditionally where we see a lot of that freight start to really pick up right before the holiday period. So again, still not through a lot of this potential tightness that we're looking at right now. So everyone will have to just stay tuned next week to see what happens. So breaking it down into reefer and dry van tender rejections. So you can see that this blue line right here, this is our reefer rejection rate. Reefer has had a much stickier path of it through the COVID outbreak and a lot of the economic shutdown period, because food and beverage, of course, strong throughout. Everybody still needs to eat. Van, however, had not been, you know, as tight as that reefer segment is, and traditionally that is the case. You know, normally compared to reefer, dry van tends to be a little bit softer market to enter because of the competition. But dry van tender rejection rates here in the orange continue to climb here, and that's what's driving that increase in tender rejection rates, 6.46% as compared to 11.43% for reefer. Again, a little bit smaller sample size there, but again, the fact that dry van continues to tighten is a significant development throughout the country. So looking at the big picture here in terms of where are these markets seeing the tightest activity, the weighted rejection index, one of my favorite to use here, just to get a quick look and see which of those markets have the highest volume and the biggest increase in tender rejection rate week over week. It's going to give you a good high-level overview of what to target out there, especially if you're looking for markets with a lot of spot market potential, or just those markets that may have increasing amount of volumes or disruption in them. If you are looking to keep your utilization factors high, you would need to target these markets traditionally if you want to increase your odds, especially if you don't have enough pre-plans going on in the United States right now. So looking at the map, you can see out here out west. Out west is still driving a lot of the tightness in the United States right now. These dark blue markets of Phoenix, Ontario, Los Angeles over here even, that we're going to get into here in a little bit. But you've got some of these smaller markets are starting to pick up out in the middle of the country as well. Not necessarily strong increases in weighted rejection index, but they are in that darker blue shade. Over there in Dallas, Fort Worth, for instance, actually has a little bit of significant activity as one of the bigger markets. Phoenix, Arizona, Ontario, as I mentioned, the two biggest weighted rejection index markets in the United States right now. Looking at the Ontario market, of course, LA, Ontario, Southern California has been a big growth market for the United States, you know, as we've been recovering from the COVID, the economic shutdown, and the Ontario volumes, you can see here in the orange line here, they are still trending higher, although they've taken a quick pause here. Still not enough to say that it's over in Ontario, but tender rejection rates still continue to climb well over national average, up over 9.5% right now in the Ontario market. So everybody should be paying attention to Ontario for sure. Tweener, long haul. Let's break down some of this length of haul real quick. And we're going to see, you see this big divergence here. You've got tweener and, or I should say short haul, mid haul, local haul freight, things moving under 800 miles. Somewhat flat, but this big divergence up here to this blue line, that is your long haul freight volume. So carriers should be having a lot of success in the long haul market out of Ontario. And that'll do it for today's carrier update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Hi, good morning, everybody. I'm Luke Falasca bringing you another broker update. And if you haven't noticed, tender rejections are continuing to rise up. They are at some of their highest levels so far this year, apart from that panic surge and a little bit that we saw at the beginning of January. But right now, if you notice that green line there, the tender rejections are hitting right about 6.4%. So actually a little bit higher than where we were this time last year. As it continues to push higher, that will increase spot market rates and tighten up capacity, largely driven by dry van freight right now. And this blue line here, those are your volume levels. We saw the big surge, that big bump after Memorial Day, but so far it's mainly been flat since then, which we expected. It's seasonally, it is flat around this month up until you get to the 4th of July, and then things start to wiggle around a little bit. But they are still quite elevated. While they are remaining flat, they are flat at a very high level compared to this year and the year before that. So that is potentially causing this tightening in capacity as carriers realize that they have more options to choose from for freight. Now, as we go ahead and look at the map here, we're going to be looking at the weekly tender rejection change. So this is the 7-day change in tender rejections. Markets in blue are where tender rejections are increasing. Those will be the markets you see the highest increase in spot market rates. The markets in red are where tender rejections are decreasing. You will see the biggest decrease in spot market rates in those markets. And then the white markets are relatively unchanged, maybe a slight uptick or slight downtick. So notice pretty much all along the border here, all along the southern border here from California, Arizona, Texas, a lot of blues happening here. Could potentially be cross-border freight, but right now tender rejections are increasing quite heavily in all of these cross-border states. So if you're moving freight out of any of these areas from El Paso, Laredo, Phoenix, and so on, you might want to increase your spot market rates. Also, if you don't have customers in any of these areas, great opportunity to call as capacity is tightening up on shippers in those markets. Perfect opportunity to potentially land a new customer if you have some extra capacity. Great opportunity to call. And then obviously pretty much all along the middle of the country here from Kansas and Nebraska, South Dakota, while there's not a ton of freight in those areas, it is tightening up as well. We're seeing tender rejections rise. Also a little bit here, looks like in Michigan's, the western part of Michigan seeing some tightening as well as sprinkles kind of all along the eastern part of the United States here. So again, focus on those blue areas to call for potential increased freight. That's where capacity is tightening the most. And then if you're moving freight out of any of these red markets today, lower your rates to your carriers day over day or week over week as the market is softening in those areas. Great opportunity to increase some margins. The market we're going to look at today, though, is Phoenix, which is traditionally a backhaul market, a heavy backhaul market, but it's not acting too much like a backhaul market right now, with tender rejections in blue really surging. If you're looking at this chart, this is year to date. Even during this panic buying surge that we saw in March, tender rejections are almost 40% higher than where they were at that peak there at the end of April. We have surged all the way up to over 13.5%, more than double where the national average is right now. That is really going to apply a lot of upward pressure on spot market pricing out of Phoenix right now, especially for dry van freight. So as you're moving more freight out of Phoenix today, understand you may pay a premium to the truck. So make sure you talk to your shippers about that. Understand that there is going to be a lot of tightening happening today as it continues to move up. Now, for comparison's sake, this green line that you see here, those are 2019 tender rejection levels. So you can see kind of where we sit compared to where we were this time last year. So as you can see, significantly higher as we continue to push up. And that'll do it for today's broker update.
Welcome to the Rail and Intermodal update. I'm here with Mike Baudendistel, our Rail and Intermodal expert. Now, We have been seeing a lot of this long-haul freight volume come up out of the West Coast. You're here to give us a little bit more insight into what you're seeing on the rail and intermodal side. What do you got?
Yeah, so LA is certainly hotter than most of the freight markets across the country. So this is first chart, we're looking at tender rejections, and for LA, 9.5%, so quite a bit better than 6.4 for the country as a whole. So just stronger truck market, and similar to the chart that you showed on Ontario, looks almost exactly the same. Looking from LA, really that. Tender rejections rising out of LA has been driven by volume. You can just see how much of this has been related to long haul volume. We define that as over 800 miles. That's in blue is the volume over 800 miles, and that's important because that is competitive with intermodal. So those are really the one that I focus on when I think about how competitive it is with truck. A couple of different data series on rates. I mean, you would expect that rates to be rising in this environment, and that's exactly what we're seeing. In green, we have the truck stop rates between LA and Dallas, and you see for most of the past year or so, they've been pretty comparable with intermodal spot rates up until recently, where it spiked to just over $2 a mile. That's $2.04. That's inclusive of fuel surcharges. In blue, we're comparing that to intermodal rates in the same lane, LA to Dallas. Those are door-to-door intermodal spot rates showing $1.70. So with that type of discount to the highway, that's where it starts to look more competitive with truck. You tend to think of intermodal, you want to get about a 15% discount. So rates sort of in that ballpark to a little bit better than that. Looking forward though, I mean, one thing that's maybe been a little bit concerning is this going to be a temporary surge? And in blue we have customs maritime import shipments in the LA basin, so that includes LA and Long Beach. You see that big spike closer to you in June, but that seems to have cracked a little bit in the last data point. So still outperforming in the green, which is customs imports, both containerized and non-containerized for the country as a whole. But certainly it's off as high, so we'll start to see whether we see that in the other metrics.
Yeah, it's always
as well.
It's always interesting to see how it translates into the other modes. Especially on the import side, it can go into a warehouse and sit for months if it needs to, and then start moving again.
Yeah, so this is another interesting one. I mean, I like to compare. You think of domestic intermodal, international intermodal as being two distinct markets, and you really see this pickup at intermodal volume has been in blue, which has been the domestic intermodal shipments. I think a lot of that is related to, like you said, I mean, stuff coming out of warehouses, so it's already domestic freight, or just the fact that there's enough excess containers that you can transload the international imported goods into domestic containers, and then you don't have to reposition the empty internationals. I think that's playing a role too. But really,
right.
this is a positive trend for the JB Hunts and Hub Groups of the world, because it has been domestic intermodal rather than international intermodal. Sort of comparing directly on these two charts between long haul volume on the highway and domestic intermodal, sort of two different things. So in blue we have domestic intermodal shipments out of LA, and then in green we have the long haul volume index. And so these are the same charts, just on different time series. So over the past 6 months, you've really seen the highway in green take share from the railroads. I think a lot of that was right. due to the time-sensitive nature of some of those shipments, but over the last month, it's been much more in parity, and actually the rail taking a little bit of share.
Right on. Well, thank you so much for those updates, and thank you guys for watching today, and make sure to check us out on FreightWaves Live and download the app and any streaming service such as Apple TV. Have a great day.